Good morning, everybody. Welcome to the morning meeting of the ARMR Investing Way. Brett Rosenthal, you're the portfolio manager on the desk. I'm the chief investment officer. I'm going to share with you my approach right now in the stock market. We're going to focus on big picture risk monitor and what it means. What are the top stocks that we're watching on the desk today for potential position taking? And I'm going to go over with you a very aggressive strategy that I almost never talk about. But I'm going to share it with you today. I'm going to tell you how I'm going to be doing it for the appropriate portfolios. And then, of course, you figure out the risk tolerance and your goals and all those things and just determine whether or not it works for you. So before I dive in, let me tell you that very dangerous market, Fed meeting this week. No one knows what the reaction to the news will be. Forget about what the news is expected. Okay, people expect the Fed to do nothing, whatever. It doesn't make a difference. It's the reaction off of whatever they say. And it's not even the reaction of the day, right? So tomorrow they come out with the announcement. It's not even that daily reaction. It's where's the market at the end of the week. So we're in this interesting risk monitor red position. Max cash, collecting 5.5% in U.S. Treasury bills. We don't have to do anything. Okay? For the conservative investor, this conversation I'm about to have with you is not for you. You're collecting 5.5%. You're waiting for the next risk monitor green signal. Take some time off. Enjoy yourself. Okay? For the rest of you who wish to be aggressive with me, I'm going to walk you through my approach now. Something I haven't talked to you about in a very long time. I don't know if I've ever talked to you about it. And I'm going to walk you through a progression of stocks. We're going to look at ETFs, and we're going to paint a picture. And then we'll talk about how to execute the strategy if you want to do it. But let me caution you before I begin to unpack this. There is nothing wrong with sitting in 5.5% Treasury bills. September is the worst month of the year. The back half of September tends to be worse than the first half. If there's ever a time for the conversation that I'm about to have with you from a statistical point of view, it's now. So let's unpack the chart patterns, and then you make a decision that suits your risk tolerance and your goals. So obviously what I'm talking about is setting up short positions on the market. Now, before I dive into that, I'm going to share with you the number one stock on the desk right now that I'm following. We began to take a position in this asset. We've traded this asset well since November. We've earned the right to trade it again. Setting up these positions in front of Wednesday is dangerous. That's the only caveat of this conversation. But where there's danger, there's opportunity. Right? So I have to just execute what I see. I can't worry about what might happen tomorrow. I don't know. None of us know. We can't run money that way. So what we can do is manage position sizes. If we see an event that could cause extreme volatility, we can manage our position sizes. We could take advantage of the volatility. Okay? But the first chart I want to go over with you, the number one stock chart on the desk today, has to be precious metals and gold. Let me close that door because it sounds like Lulu is in total agreement with this conversation this morning and she can't keep quiet. All right. What we're looking at is the chart of spot physical gold. The green arrows are the times since November that we have bought gold and traded it at the red arrows. We buy the green boxes, we sell the red arrows. Buy the white box, sell the red arrow. Buy the white green box, sell the red arrow. Did it again recently, made money on that trade. Here we have a higher low in gold. Let's blow it up so you can see it. Okay. There's the downtrend, broke the downtrend, pulled back, made a higher low, a perfect, you could almost call this right here a 3-bar reversal right there. This down bar, the test of the 200-day moving average, which is the green line, and a gap up. That's what turned it white box again. And we closed above the high of that box yesterday. So we began adding gold back to the portfolio. The stop is pretty simple, and we've earned the right for this. You know, takes out that low, trade is over. Not a lot of risk from here. Breaks out of this downtrend, huge upside. Let's take a look at Sprott Physical Silver. Did the same thing in Sprott Physical Silver. Buying it down here. Buying it down here. Selling it up here. Buying it, selling it. We're just trading silver along with gold the whole way. Same situation setting up in silver. There it is. Let's zoom in a little bit. Okay. 3-bar reversal. Perfect. Shake out, gap up, testing prior week, a prior bottom, making a double bottom. Silver hasn't even closed above the moving averages yet. That's how early it is in silver. So we begin rebuilding our precious metals positions. We start with physical gold and silver. At some point way out there in the future, when the dollar is breaking down and gold and silver are going berserk, I'm going to want the physical asset. Okay. If you want to just trade it, you can easily go with AGQ and UGL, which is double both of those assets. There's AGQ. And I would move this down here. There's your double bottom, AGQ, UGL. These are twice the performance, right, of gold and silver. You could do those, but honestly, so in a trading portfolio, that's the better way to play it, right? All the way since November, the way to play it is double gold and silver. You make more money, and we're trading it. So if we continue to trade it, that's the way to do it. If we're concerned about the world around us, you own physical gold and silver, because one day the uptrend gets going and it never looks back, and we're going to want the physical metal. So I'll leave that up to you. Normally, what we will do now is start to, if we're making money in gold and silver, we start to fill out the portfolio of some mining stocks. I didn't do that last time because the political environment has changed to such a degree that I'm not confident in any individual mining company. I don't know what story is coming out next of a socialist bent that is negative for the mining companies. You know, as the price of energy goes a lot higher, which is what, the 20-25% of the costs of mining metals. I mean, it's just everything is pointing to a higher metal price, but more pressure on miners. Now, the miners will go up anyway. If the price of the metal goes up a lot, miners are going to skyrocket. But I'm no longer trying to figure out which ones I want to own. I'm done with that game. All I want to do is own twice the performance of GDX and walk away. I think you'll be hard pressed to find individual miners with the right reward to risk setup that will double the performance of GDX. So I'm just going to go with Nugget. What I like about this setup is that GDX has actually given us a risk on entry point ahead of the metal itself. While the metal was testing the lows down here, notice how GDX, which is the group of all the miners, made a higher low. So this is a much more bullish setup than it was back here. And we traded down here for profit. Look at, in fact, do I have it up here? Let's look at them side by side. Here's Sprott Physical Gold. Okay, there's Sprott Physical Gold, and here's GDX. And what I like about GDX this time around is that while gold was coming down here and testing this support, GDX is making a much higher low and is already challenging the highs in here. See, gold hasn't challenged the high back here, this August high. The miners are about to take out the highs of August. So now you have the mining stocks leading the metal, and that's generally the best time to own the metals. So we're going to put that trade on. So in a market where the metals are going up, sometimes that's a fear trade. Sometimes that's because things are going on around the world that are putting equities down. People are moving money into metal stocks. I'm not sure that's going to happen this time around, but I'm going to share with you now the portfolio I'm setting up for an aggressively traded portfolio. I'm going to say it again. Disclaimer. Conservative portfolios should not be shorting. Be content at 5.5% Treasury bills. Wait for the next risk on entry point. That's it. Be patient. Don't get involved in what could be a shredder of a market when the Fed makes their comments tomorrow. Okay. Having said all that, I believe it's time to begin building a short position. And I'll know if I'm right by the end of this week. I'll either be out of my shorts by the end of this week, or I'll be doubling and tripling my positions. It starts with the small cap index. And I'm going to pull this up for you because it looks like this. This is a classic head and shoulders pattern on small caps. It's a 4-month pattern. Typically, you'd like maybe 6 months, a little bit longer to form. I submit to you, in the world we live in today, the typical norms are happening faster and faster. So 4 months is enough for me. That index looks like it's done. I have an interest in getting short small caps. And one way to do that is twice the performance of IWM by getting long, the negative performance, ultra short. So TWM, this chart right here, is twice the performance of IWM on the downside. IWM breaks down, TWM breaks out at twice the rate. IWM's down 1%, this asset's up 2%, theoretically. It's probably how I'm going to play this. And of course, we could look at this chart all day, but it's kind of a waste. All I'm really doing, this is the chart I'm looking at, right? This looks like it's headed down to the lows of last year to me. We're in this washing machine of a market, a head and shoulders pattern set up. The uptrend is broken. The neckline is next. And then I would expect a short trip down to here, at the very least. So we're looking at a 6.5% move on the index down to here. So you're talking about 12 or 13% return on double that move, right? In a portfolio. 20%, 20 to 25% of this index are small cap banks. Let's go look at small cap banks. What does that look like to you? That looks like a death walk to me. This is the SVB crash, SIVB crash. This is the recovery. Everyone's kind of forgotten about it. It's in the rear view mirror. You look at that chart. You want to get long that? That looks like an asset about to head down and test the lows to me. That's what it looks like to me. It's about to head down. It breaks that support level, and it's going to head down to these lows. And does that coincide with another high-profile banking blow-up? I don't know. But the Fed keeps raising rates. Even if the Fed stops raising rates tomorrow and says, we're going to wait, we're going to see, blah, 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 the reaction to the news will be key. KRE breaks down. IWM is going to the lows of last year in that box. That's a 12 to 13% move on the upside for TWM. I might even go short KRE. I might be short KRE, long TWM. And then I'm going to have to show you this chart because I have been hunting this short for a long time. And I submit to you the time is now on home builders. The time is now on home builders. I do not understand the levitation in home builders since May. I don't buy the argument. There's not enough homes for all the people. I don't buy it. There's not enough inventory. I don't care when interest rates are going through the roof and people can't get a mortgage. I don't buy it. Luckily, maybe not luckily, because I refuse to force my will on the market, I haven't shorted. And the asset keeps going up. And I say, okay, I just don't get it. I just don't get it. All right. Now the technicals are lining up with the fundamental story. The fundamental story to me is that housing stocks can't go to all-time new highs with interest rates at the level they're at. The hackneyed story of there's not enough inventory for the people looking for houses, that's what drove these things back to the highs of 2022. Where are they going from here? I already know there's a shortage of, I get it. Where are they going from here as rates keep going up and then the Fed keeps rates here longer, blah, blah, blah. The technicals have set up with the fundamentals, and I'm probably going to put a short position on home builders in here. There's the highs of 2021, actually. The big down bar, the recovery. The big down bar, smaller recovery. Now we're below. We take out that low, and it's over for the home builders. I submit to you that a short portfolio of small caps, banks, and home builders would look really nice next to a long portfolio of energy and precious metals. So as energy stocks and uranium stocks are doing this, for somebody who doesn't want to reduce their exposure to energy, a hedged book might make sense. It might. And you might make money on both sides of that trade. Because theoretically, the price of energy going a lot higher, inflation, makes it harder and harder for banks and home builders to perform. So gold, silver, uranium, energy, higher. Small caps, banks, home builders, lower. That could be a very good book. So these are my thoughts for you this morning. And I'm going to end it on this note of caution. Everything I'm saying could be thrown in complete disarray depending on what the Fed does tomorrow. So we have to recognize that. It's possible, but as an example, everybody expects the Fed to blah, blah, blah. let's say the Fed surprises everybody and says, we've overstepped. We understand that inflation's contained and it's time for us to start reducing rates. Nobody thinks that's going to happen. I'm just telling you. If that happens, forget my short positions are going to get crushed, right? I have to make an educated guess that that's not going to happen. That what the Fed's going to do at best, which everybody already expects, is that they're going to take a break from raising rates and they're going to talk about watching what happens going forward and all the other mumbo jumbo that they say, right? And they get more and more opaque as they go. And it's, we all have to come up with a kind of a goalpost of what we think is going to happen, and we execute based on price action. So what I'm suggesting to you is there needs to be pain in the equity market for the Fed to start cutting rates. That's what I'm saying to you. I'm going off of that expectation. That doesn't mean that the market can't go up. I'm saying if the market keeps going up, the Fed's not cutting rates. If the Fed's not cutting rates, banks and home builders are in big trouble. And I think Noel just put into the room that the price of supplies, cost of materials to build houses keeps going up. Is that what you just said? No, if you did, I haven't even thought about that. You're absolutely right. Small cap banks, commercial property overhang. Yeah. Commercial property overhang for small cap banks. Costs of home buildings going through the roof. These are things fundamentally, right? And so my expectation, now I have to read and react to price action. So I could be wrong and I'll have to adjust. But my expectation is that the Fed won't cut rates until the equity market has had a significant sell-off and they have to cut rates. The market's pricing in a soft landing and a Fed that's going to do the right thing and stop raising rates and start. I don't know why the market's pricing that in. The Fed hasn't done that yet. So look, I don't want to force my will in the market. If I have to cover my shorts, I will. But if there's ever a time to put on some shorts, to me, it's now. And if I'm long a portfolio of energy and uranium and whatever, hedging that portfolio makes sense to me now as well. I get to the end of this week and the market's up huge, then everything I've said to you is obviously incorrect at the moment, and I'll adjust. Risk monitor goes green, huge up week. Okay, fine. I'll put money to work on the long side. But as we sit right here, right now, I'm going to begin building these positions. And I intend to finish them off by the end of the week if they're going in the direction I think they're headed. Those are my thoughts for you today. You're the risk manager of your own assets. You're a portfolio manager on a virtual hedge fund desk. Act accordingly. I look forward to working with all of you on the live desk at 9:30. For my conservative portfolios, it's the ARMR carry trade, and it's lots of fun. I collect 5.5% in treasury bills. So I wake up this morning and I see my screen green because it's collecting every day. And then I go out there and I try to extract alpha long the S&P and the NASDAQ when I get a play out of the playbook. Some days, big moves, other days, nothing, and we're just waiting for the next day. That's the process. That I'm going to keep doing. And that works in a bear market and a bull market. It doesn't make a difference. It's harder in a bear market. There are more blocking and tackling days, but there's also larger volatility and you get huge moves. So if we stay at it and we're patient, we'll capture some pretty big moves if it goes into a bear market. We're smart trading, not day trading. I don't have to trade every day. I'm collecting interest. If it sets up, I put capital to work. So I look forward to seeing you all on the desk, 9:30. Thanks for spending time with me this morning. I wish you all success investing and trading, and I'll see you on the other side, guys.